Achieving financial independence and creating wealth are aspirations shared by many. However, a lack of knowledge and confidence often hinders individuals from realizing these goals. Success is not an accident. Life is governed by principles, and if you are abreast with the guiding principles and you apply them to your daily living, you'll get the equivalent results. Just like every aspect of life is governed by principles, wealth creation is also governed by principles. Unfortunately, these principles are hidden from the poor, and they are made to believe that they cannot understand these principles, apply them and get results. They are deceived that these principles are for a select few, but this is a complete fallacy. In this video, you'll be exposed to proven principles of wealth creation and taught how anybody can apply them to create and manage wealth irrespective of their status. Before we dive right in, kindly hit the subscribe button now to have first-hand access to more of these videos. Also like, comment, and share the link to this video with your friends, family, and loved ones that you know will benefit from it. This is actually one of the secrets to becoming rich, the willingness to always share knowledge. So subscribe now, like, share, and let's continue. So here we go. What is wealth creation? Wealth creation refers to the gradual accumulation of assets, particularly those generating income, over an extended period. It involves informed decision-making, smart money management, and strategic investments to achieve short, medium, and long-term financial objectives. This immediately suggests that wealth creation is a process. It has a defined pathway. Take note of the phrase, gradual accumulation of assets. So wealth creation involves the accumulation of assets and not the purchase of liabilities, and the process of wealth creation is gradual. It requires time, and you must be consistent in applying the principles. Before you continue this video, feel free to check the description section. There are several links to learn ways to increase your earnings as a part of your wealth creation process. Now let's enumerate the basic foundational principles of wealth creation. Where should you begin? Just follow this video carefully and ensure you watch it to the end. You'll be amazed at your discovery. Create a roadmap for financial success. This is where it all begins. Establishing a well-defined roadmap to guide your financial decisions is the first step you must take in your wealth creation journey. It is important to define exactly what you want, and how far you want to go in your financial journey within a specific period. So here is how to begin. Assess your current financial situation, including income, expenses, assets, and liabilities, to identify areas for improvement. You need to be very sincere with this. You cannot move from where you are until you identify and come to terms with exactly your current status. Guess what? It doesn't matter where you are at the moment, because if you follow the principles taught on this channel, you can move from zero or even minus to becoming wealthy and financially free. That is what this channel is all about. To guide you on your wealth creation journey from scratch to becoming very wealthy. So don't be afraid to come to terms with your current financial status. Honesty with oneself is paramount to achieving success in life. Define your financial goals, breaking them down into short, medium, and long-term objectives. Goal setting cannot be divorced from achieving success. Clearly defined goals will help you measure your progress within a given time and also guide you on what next to do at every point in time. So ensure you set clear and realistic and time-bound financial goals for yourself. Prioritize paying off high-interest debts to free up more funds for saving and investing. You must learn to master debt management and use debt to your advantage. If not, it will greatly inhibit your progress in your journey to financial freedom. I will recommend that you search for and watch the video on how to build wealth using debt on this channel. Regularly monitor and adjust your financial plan to adapt to changing circumstances. As it is commonly said, change is the only constant thing in life. You must be flexible to adjust your financial plans to match up with changes in the economy and other factors. Spend less than you earn. A crucial step towards financial freedom is creating a realistic budget and closely monitoring spending habits. Budgeting is akin to a roadmap that allows you to work towards financial independence methodically. Spending less than you earn is a fundamental principle of personal finance and a key step toward building wealth and financial stability. Here are some tips on how to achieve this. Create a budget. Start by tracking your income and expenses to understand where your money is going. Create a budget that allocates a certain portion of your income to essential expenses like rent, utilities, food, and transportation, while setting aside money for savings and discretionary spending. Cut unnecessary expenses. Analyze your spending habits and identify areas where you can cut back. Look for subscriptions or memberships you no longer use, dining out too often, impulse purchases, and other non-essential expenses that can be reduced. Prioritize saving. Make saving a priority in your budget. Aim to save a certain percentage of your income each month, and treat it like any other essential expense. Consider setting up an automatic transfer to a savings account to make it easier. Avoid debt. Debt can be a major obstacle to spending less than you earn. Try to avoid taking on unnecessary debt, and if you have existing debts, work on paying them down as quickly as possible. High-interest debts, like credit card debt, should be a priority to pay off. Live within your means. Avoid the temptation to spend more just because you have a higher income. Stick to your budget and live within your means to ensure that your expenses do not exceed your earnings. Comparison shopping. Before making a purchase, shop around to find the best deals. Compare prices and consider waiting for sales or using discounts and coupons to save money. Build an emergency fund. Having an emergency fund can protect you from unexpected expenses and keep you from going into debt. Aim to save 3 to 6 months' worth of living expenses in an easily accessible account. Increase your income. Look for opportunities to increase your earnings, such as taking on a side job, freelancing, or seeking a promotion at your current job. Talking about side hustle and increasing your income, check the pinned comment to consider having a YouTube channel as a side hustle. The more you earn, the easier it becomes to spend less than you make. Avoid impulse buying. Practice mindfulness when making purchases. Avoid impulsive spending by taking some time to consider whether the purchase is necessary and fits into your budget. Track your progress. Regularly review your budget and track your progress. Celebrate your successes and make adjustments as needed to ensure you continue spending less than you earn. Remember, spending less than you earn is about making conscious decisions about your money and being disciplined with your finances. By following these tips, you can work towards achieving your financial goals and building a secure future. Invest wisely. Investing your money wisely is vital for achieving wealth creation. Focus on assets that offer both capital growth and income, such as direct investments in shares and property. Additionally, ensure you have an exit strategy in place to manage investment risk effectively. Okay, let's talk more about exit strategies in managing investment risks. As already established, this is vital to investing wisely. What are exit strategies for managing investment risks? Exit strategies in managing investment risks refer to plans or actions taken by investors to protect their investments and minimize potential losses. Having a clear exit strategy is essential to ensure that you don't get caught in a declining market or hold on to poorly performing assets for too long. Here are some common exit strategies to consider. Stop-loss orders. A stop-loss order is a predetermined price level at which you will sell a security to limit losses. For example, if you set a stop-loss order at 10% below the current market price, the position will be automatically sold if the price drops by that amount, preventing further losses. Take-profit orders. Take-profit orders are similar to stop-loss orders, but they are used to lock in gains. You set a specific price target, and if the investment reaches that price, it is automatically sold, securing your profits. Diversification. Diversifying your investment portfolio across various asset classes, industries, and geographic regions can help reduce risk. By spreading your investments, you won't be overly exposed to the fluctuations of a single asset or market. Rebalancing. Regularly review and rebalance your investment portfolio. Rebalancing involves adjusting your asset allocation to maintain your desired risk level. It may involve selling assets that have performed well and using the proceeds to buy underperforming assets. Time-based exit. Determine a specific time horizon for your investments. If an investment hasn't met your expected returns within that time frame or no longer aligns with your financial goals, consider selling it. Monitoring financial news and market trends. Stay informed about economic and market conditions. If you notice negative trends or fundamental changes that could impact your investment, consider adjusting your strategy accordingly. Trailing stops. A trailing stop is a stop-loss order that moves with the market price. As the investment's price increases, the trailing stop order adjusts upward, allowing you to lock in profits while still protecting against sudden declines. Cutting losses. Be prepared to cut your losses if an investment is consistently underperforming or if the reasons you initially invested have changed. Don't hold on to a losing position in the hope that it will rebound. Assessing long-term goals. Regularly reassess your long-term financial goals and how your investments align with them. If an investment no longer fits your objectives, it may be time to exit. Hedging strategies. Consider using hedging instruments, such as options or futures contracts, to protect your portfolio from potential adverse market movements. It is important to realize that no investment is entirely risk-free, and no exit strategy guarantees profits or eliminates all losses. The key is to have a well-thought-out plan and to stay disciplined in executing it based on your risk tolerance and financial objectives. Disclaimer: this channel is just to educate generally. Please do your research before you invest. This video is not to act as a financial expert for investment decisions. Contact your financial advisor before you invest. Let's continue as we look at other fundamental principles associated with wealth creation that the average person is oblivious of. Harness the power of compounding. Let your investments grow over time and take advantage of the power of compounding. Reinvesting earnings from investments into the portfolio results in exponential growth over the long run. Compounding profit in your investments is a powerful way to grow your wealth over time. Compounding allows you to earn returns not only on your original investment but also on the accumulated interest or gains from previous periods. Here are the steps to take advantage of compounding profit in your investments. Start early. The earlier you begin investing, the longer your money has to compound. Even small amounts invested regularly can grow significantly over time. Set clear financial goals. Here we go again, as it cannot be overemphasized. You must define your financial goals, both short-term and long-term. Knowing why and what you are investing for will help you stay focused and committed to the process. Invest regularly. Make regular contributions to your investments. Whether it's monthly, quarterly, or annually, consistent contributions will help maximize the benefits of compounding. Choose the right investments. Select investments that align with your risk tolerance, financial goals, and time horizon. Diversify your portfolio to spread risk and enhance the potential for compounding. Reinvest profits. When your investments generate returns, reinvest the profits rather than withdraw them. By doing so, you can benefit from the compounding effect on both your initial investment and the gains. Stay invested for the long term. Compounding works best over extended periods. Avoid the temptation to make frequent changes to your investments based on short-term market fluctuations. Take advantage of tax-advantaged accounts. If available in your country, consider using tax-advantaged accounts like IRAs, 401ks, or ISAs. These accounts offer tax benefits that can further enhance the power of compounding. Avoid high fees. Be mindful of investment fees and expenses. High fees can eat into your returns and slow down the compounding process. Monitor and rebalance. Regularly review your investment portfolio and rebalance it if necessary to maintain your desired asset allocation. Rebalancing helps you stay on track with your financial goals and risk tolerance. Stay patient and disciplined. Compounding takes time, and the most significant gains often occur in the later years. Stay patient. Remain disciplined with your investment strategy, and avoid making emotional decisions. Automate investments. Consider setting up automatic contributions to your investment accounts. Automation makes it easier to remain consistent and committed to your investment plan. Educate yourself. Continuously learn about investing and personal finance. Knowledge will empower you to make informed decisions and navigate the investment landscape more effectively. Kindly note that compounding is not a get-rich-quick scheme, but rather a gradual and steady process. By staying committed to your investment plan and allowing your money to work for you over time, you can benefit from the incredible potential of compounding profit to build wealth and achieve your financial goals. Diversify your investments. Minimize risk and optimize returns by diversifying your investment portfolio across various asset classes and sectors. This approach provides a buffer against poor performance in any single investment. Diversification is a crucial strategy to spread risk and potentially enhance returns in your investment portfolio. By investing in a variety of asset classes and industries, You can reduce the impact of any single investment's performance on your overall portfolio. Here are some areas to consider when diversifying your investments. Stocks. Invest in stocks of companies from different sectors and regions. Consider large cap, mid cap, and small cap stocks to diversify across different market capitalizations. Bonds. Include bonds in your portfolio, such as government bonds, corporate bonds, and municipal bonds. Bonds can provide stability and income. Real estate. Real estate investments can offer diversification through properties, real estate investment trusts, REITs, or real estate crowdfunding platforms. International investments. Consider investing in international stocks and bonds to gain exposure to global markets. Commodities. Commodities like gold, silver, oil, and agricultural products can act as a hedge against inflation and currency risk. Cryptocurrencies. For those with higher risk tolerance, cryptocurrencies can be an option for diversification. However, keep in mind that cryptocurrencies are highly volatile and speculative. Mutual funds and ETFs. These investment vehicles provide instant diversification as they pool money from multiple investors to invest in a wide range of assets. Index funds. Invest in index funds that track broad market indices, offering exposure to a diverse set of companies and industries. Sector-specific funds. Consider sector-specific funds that focus on particular industries, such as technology, healthcare, or energy. Cash and cash equivalents. Maintaining some cash or cash equivalents in your portfolio can provide liquidity and flexibility during market downturns. Dividend-paying stocks. Invest in stocks of companies with a history of paying dividends. Dividend income can provide stability and serve as an income stream during market volatility. Peer-to-peer lending. If you're willing to take on some credit risk, peer-to-peer lending platforms can diversify your portfolio into personal or business loans. Startups or venture capital. For sophisticated investors, investing in startups or venture capital funds can offer exposure to early-stage companies with high growth potential. Precious metals. Apart from gold and silver, consider other precious metals like platinum and palladium to diversify your portfolio further. I believe the above areas enumerated have broadened your horizon on numerous available opportunities to diversify your investments. However, note that diversification should be based on your risk tolerance, financial goals, and time horizon. It's essential to regularly review your portfolio's performance and rebalance when necessary to maintain your desired asset allocation. Additionally, seeking advice from a financial advisor can be beneficial to ensure your investment strategy aligns with your individual circumstances. Educate yourself about wealth creation. Financial education is paramount for successful wealth creation. Acquiring knowledge about personal finance, investment strategies, and market trends empowers you to make informed decisions and avoid costly mistakes. Maybe this would have been the first point to mention. You cannot overemphasize the need to educate and re-educate yourself in any field of endeavor where you want to be a master, and wealth creation is not an exception. You would have observed that we kept on referring to the need to educate yourself on different subjects in this video. So much information has already been made available to you in this video, and you're watching this video to this point and subscribing to this channel is proof that value education, because that is what this channel is all about. Educating you on building wealth from scratch and gaining financial freedom. There is an avalanche of resource materials available on the internet that you can take advantage of to educate yourself on the nitty-gritty of wealth creation and management. I will, however, advise that you don't just jump on every information or guideline you see on the internet. You should verify the information you get and ascertain its practicality and authenticity before making use of such information. Conclusion. Wealth creation is a lifelong journey that demands patience, perseverance, and continuous learning. By adhering to the principles outlined in this guide, you can take control of your financial future and work towards building lasting wealth. Embrace these principles, and you will unlock your potential for financial success and independence. Remember, the key to wealth creation lies in knowledge, discipline, and a growth mindset. If this video was beneficial to you and you learned something for yourself, please share what you learned with others in the comment section. Also, kindly share the link to friends and loved ones that you know will also benefit from this video, and also subscribe to this channel and turn on your notification button for more content. See you in the next video.